Robschild, no investment advice. Welcome to the show where we view financial markets using Ben Graham's investment philosophy, macro technicals, and crystal ball gazing. Today is Monday, November 25th, 2024. Today's episode begins with Macro Monday, a daily reminder review. When making investment decisions, I believe that these items are very important to consider as the backdrop to what's going on in the economy, in the financial world. And so here they are. We're going to start with mentioning again the 2-year, 10-year Treasury yields were inverted for over 2 years. Bull steepening reversion happening on September 6th, 2024. Quick side note, according to the closing yields of today, we actually re-inverted today by a little tiny bit. I don't know if we're going to count that or not. The Fred website still says we're uninverted, so that might be on an opening basis or something like that. But until we're more solidly inverted again, I'm going to count this as still being in a reverted state. Now, typically when the 2-year, 10-year Treasury yield becomes inverted, that spells out that investors are expecting the economy to slow down in the future. The reason you can have the 2-year yielding higher than a longer duration security, which would normally give you a higher rate of return, is because the market believes that right now borrowing costs at the front end of the curve and the federal funds rate are too high, and that they are so high that they are going to restrict the economy enough to the point where they actually have to lower that rate again in the future to help things move forward again. Now, with it being inverted for a solid 2+ years, it suggests that we are headed into a pretty extreme situation, actually, not just a regular recession or soft landing, certainly not a soft landing. This is the kind of thing that you see before things like the Great Depression. This is not something to be taken lightly. If you had, I guess bull and bear start with the same letter, so I have to put bull there. Bull steepening reversion occurring instead of bear steepening reversion. It says that the yields are generally going down here, not up. If they were going up, then that would be bear steepening, and that would be better news. Although, coming out of an inverted state is typically the market signaling, okay, yeah, the Fed is now lowering rates so that it helps the economy move forward because things are falling apart here, that we're at that part of the business cycle. That's what it suggests. Also, the SOM rule was triggered in July of 2024. Every time this has been triggered in the past, with unemployment rising at an unsustainable pace, it suggests that the recession is actually here. Add to the chaos, the S&P 500 is currently sitting at a PE ratio of 31. From multipl.com, you can see the S&P 500 PE ratio going back about 150 years. You can see that a typical range of this is between 10 and 20 for the most part, although since 1980 having rates go abnormally low, we've managed to maintain a slightly higher PE ratio on average for the past 2 decades or so. Any which way you look at it, yields are not crazily low anymore. The 30-year being over 4% yield right now as we speak. And also, we haven't had a major earnings contraction period. Sometimes you see the PE ratio spike up because earnings have gone down, therefore making the price seem higher. But instead, we've had basically flat earnings and the price just soaring higher and higher and higher. When this happens, like it did, for example, in the dot-com bubble, getting up to a level of 46, it simply suggests that, stocks are expensive, however you want to look at it. This number, the PE ratio itself, it's the cost of stock that offers $1 of return. So if you buy $30 of VU right now, $30 of VU earns $1. In the past, we've seen it as low as $6 for $1 of return. So, you tell me, would you rather pay someone $6 for $1 of return every year? Or would you rather pay $31 for $1 of return every year? The market's very expensive right now. Another way to do this is to take a look at, on the same website, MLUTPL.com, the Shiller Index, also known as the CAPE ratio. This measures the price earnings ratio based on an inflation adjusted earnings from the previous 10 years. And when this gets out of control, like it did in 1929, going all the way up to 31, it can spell very low equity returns over the foreseeable future. In the 1929 case, it was such that you wouldn't get your money back to that same nominal level for about 30 years. And considering that there was inflation, you're not talking feeling rewarded by your investment for even longer than 30 years. Can you imagine that? Being invested in the late 1920s when stocks were so hot and everybody had to get in and everything was great and the party was going. The market was just going to keep going up forever. There were articles written in Women's Magazine that everyone should be rich and, just keep buying stocks, guys. Late 1920s. Well, here we are in the mid 2020s here at a much higher Cape Shiller ratio index of 38. What could possibly go wrong, guys? Don't worry, stocks will just keep going up forever. Who cares about the valuation? Who cares about how much money they make? This is an extremely dangerous and an extremely expensive market, all while people holding their stock funds are feeling very safe because they see the value of their stocks being very high. This is an absolute misconception. This is one of the most dangerous times in all of American history to be in the stock market, generally speaking. And it's not just the tech stocks. When Costco and Walmart are selling at PE ratios near 40, it's like an everything bubble. There's no other way to put it. Add to that house costs right now. The housing costs are never higher. The median house price to the median income, it's at about 7, which it's never been that high since the great financial crisis and the housing bubble of 2007. But what could possibly go wrong? Adding to the daily reminders, rate cuts began September 18th, 2024 with a solid 50 basis point cut instead of the typical 25 basis point cut, suggesting that the Fed was fearful at that point. Since then, the Fed has come out to be a little bit more hawkish. Although the Fed has been seemingly a little bit more hawkish in their tone lately, we still did have that 25 basis point cut in November. It's 50-50 now if we're going to see one in December as of today. Now, although the 2-year, 10-year yield curve has been reverted to a normal state, we haven't got there yet in the 3-month 10-year, which when that becomes reverted, that's when, we're fully uninverted, and now the Fed is like trying to turn the economy back on after strangling it. Now, while we're sitting today at the end of November 2024, the 3-month 10-year yield curve is still inverted. And even though the Fed has come out publicly stating explicitly that they don't want to see further weakening in the labor market, they are still currently at rates that are above the rest of the curve, making them still restrictive. The Fed is still strangling the economy. Contrary to what you may be hearing about the Fed easing monetary policy, all they're doing is strangling it a little bit less. The rest of the market has lower yields across the curve. This is a restrictive market that we're still sitting in today. With all of this in mind, the crystal ball readings remain that the S&P 500 is currently priced like a Ponzi scheme, not based on any kind of safe, real value, but rather depending on someone else to pay higher for the price that you paid today, and that's it. There's not the value to back it up, not at these prices. It also suggests that there is a bear market imminent, and I am in the camp where I believe the Fed won't cut fast enough to save the economy, even if they try. If they try to cut, and save, they're going to find that those cuts are not as effective as they hope. And that's because we're closer to a fiscal dominant situation. With the enormous amount of debt that we have, monetary policy is less effective in its ability to shrink inflation by raising rates, as well as get the economy going by cutting rates. Before continuing on, I'd like to express my sincere gratitude for those of you supporting the show. I've gotten some very nice, very generous donations and lots of views and likes. I love it all. Support the channel any way you please. Moving on in our daily episode, next item on the agenda, grain of salt, week of lighter volume. This week being Thanksgiving week, a lot of professionals are home, a lot of institutional people that control a lot of things going on. They set the machines on to do what they're supposed to do, and volume gets light. And, generally speaking, this is one of these times that you got to take things with a grain of salt, not take too many market movements too seriously. Although one very interesting thing that came out that I think affected markets today was Buffett for Treasury. It sounds like, from what I gather, he is a friend of Wall Street and hawkish. So what it says to me is, we may see, for example, less support of entitlement spending. The 10-year yield, for example, dropped off pretty strongly today. And I think that's a little bit of short covering. The worst of the news is behind us. People have been talking about, they're worried about, no one being on the scene that seems like they're interested in being fiscally responsible at all. And, maybe this guy is, sounds more fiscally responsible than maybe some other potential choices. That's kind of how I'm seeing what might be going on with that. Also in headlines, as you probably saw today, stocks are going up because they chose this guy and he's a friend of Wall Street. Again, the daily reminders suggest that there isn't much intelligent investing going on, let's say, in a lot of stocks right now. And that's all really I have to say about that. And it has nothing to do with politics. It has to do with valuation and where we are in the business cycle more over everything else. Last thing on the agenda, initial jobless claims and PCE data actually comes out Wednesday. Usually we get the initial jobless claims report coming out on Thursday. I think it's because of the Thanksgiving holiday that we get that number a day early. We'll get onto the charts in a second, but again, grain of salt for everything going on this week. With the lighter volume, you might be able to suggest that, the next week may reverse everything that's happening this week and more. On to the charts, starting with the SPX, the S&P 500. We basically hit what we can consider to be a double top, basically touching the all-time high today, forming a doji pattern, which can signal a reversal. I'm biased to believe that the market will be going to the downside because of, again, the daily reminders. But I also can't control Mr. Market. He'll do whatever he wants to do, and if he wants to keep the price going higher, he'll do so. I've been bringing up on many shows recently the 10-year break-even inflation rate. This is what the market is currently pricing the average inflation rate to be over the next 10 years. One of the better reliable indicators, over people's fears or doubts about what's happening or what might be happening with inflation. I did find it interesting today that it seems we're, after going completely flat for, what is that? Almost a week and a half, 2 weeks or something like that, not budging from the 2.33 to 2.35 range. We finally broke to the downside actually at 2.29 today. I've been saying on the show I would suspect at this point in the cycle and with everything going on, it would make total sense for this market to start pricing in lower expectations of future inflation rate moving forward. Again, remember, the Fed is still actually strangling the economy here. They're lowering rates, but they're not turning on the money printer right now. It's still restrictive. We're still in a restrictive mode. And so it makes more sense for this to continue down to the downside. Very important metric to keep track of. Next, we have TLT. Like I always say, my favorite place to be. I now have 56% of my portfolio in here, as TLT broke majorly to the upside off of this Besant Treasury news. It seems like that's what drove it to the top of this descending, widening wedge. Again, this pattern after move to the downside is most likely to break out to the upside. I did say on Friday, after this large red candle and all of these little candles inside of it, that it was actually more likely to break down to the downside. Instead, we broke massively to the upside here. So this may be the last knock on the door of TLT to the upside. It looks like it wants to go higher. This is not like also a little tiny candle. It's a decent, mid-sized candle, relatively speaking. So from a crystal ball charting standpoint, it looks like TLT might continue to do well here. As I've brought up on probably the previous 10, 20 shows at this point, the TNX, the 10-year Treasury yield, going from the top here in 2021, forming, hitting the bottom, hitting this same line twice in this very formidable head and shoulders top formation, breaking down to the downside. Now it's getting very, very exciting. I've been talking about this forever, talking about how we've been fighting this sort of battle here, just going sideways, back and forth on this purple line here. And I was like trying to figure out, is this like, are we really headed into higher yields on the 10-year Treasury note? I had my extreme doubts, and my doubts were correct so far. We broke down in the 10-year Treasury note yield strongly today. I mean, there's no other way to put it. I mean, it would be even stronger if it was like a larger red candle, if we opened higher and it got driven down during the day. Who knows? Maybe we would have seen that if this wasn't a Thanksgiving week and the pros were in the market. My crystal ball says that may have been what was going on. Anyway, you look at it, 10-year note yield dropping significantly today. Gold dropped by 3.3% today. After going down here, this looks like maybe we're starting a new leg to the downside in gold. Not really sure. Again, after climbing so high so quickly, we're clearly above any kind of, moving average line you want to throw in there, whether it be 18-day, 50-day, 100-day, 200-day, 500-day. Some people use the 1,000-day. We're obviously way above all those averages, and it's normal for, any market to get back to its averages eventually. Being so overextended, I favor the view that gold will go to the downside, contrary to what you probably hear most people say about gold. Again, this whole idea that the dollar is dead, and these kinds of ideas that the dollar is just going to lose all of its value, that's end of the world kind of stuff. If you really believe that, The only investment you should be making is in ammo, actually. Ammo and land. That's all I have to say about that. If you don't think it's the end of the world, then gold looks pretty expensive. There's no other way to put it. Now, another market caught my eye today was wood. I mentioned yesterday we broke to the upside. Surprisingly, I thought this head and shoulders pattern, because it was seeming like it was just drawn by a person, literally just drawing the thing, that it would for sure, and had very high probability to get to the target of this pattern to play out to the downside in this wood ETF down to 73. Today we popped way higher, 2%. This is likely on the back of rates going lower. Whenever you have a major move in bond rates and treasury note yield going down, it means that mortgages will go down. The mortgage, the rate that you can get on mortgages is going to be cheaper, and so that gives a lot of strength for wood to go up, because it just allows more people to, invest in homes. Next market that caught my eye today, international market. Some of these markets like gold and oil, and the dollar itself, it involves everybody in the world, and not everybody in the world celebrates Thanksgiving. So some of these charts have a little more weight than others. But anyway, any way you look at it, oil dropped pretty strongly today, 2.7%. Seems like we're headed back down to this line here. And if we have this line going back to July of 2024, that's really where the market, the longs had to come out. It looks like we're headed straight back down to this line. And after knocking on it 1, 2, 3, 4 times very recently, after having this line set up since 2021, it almost seems, it seems to me with a higher and higher probability and conviction that oil wants to go to the downside. And when it does, I'm hearing people have a target of around $35 a barrel in oil, believe it or not. One fascinating thing, if you watch charts for long enough, is how world events, black swans that seem to come out of nowhere, the patterns of the charts were like saying, yes, this is coming, and it comes like right on time. It's amazing how frequently that happens. It's pretty bizarre, to be honest. But so yeah, is this it? Is this like the slowdown? Are we headed into emergency Fed cuts, which won't save the economy because that's too high, by the way, again. Anyway, I digress. Moving on, Bitcoin taking a breather here. At one point getting down today to $92,600 today, as it stands, going down 3.7%. What's interesting about this is also that, because gold went down today, Bitcoin went down today. Also, I didn't bring up the chart. The dollar also went down today, all on the same day, very interestingly. So what will be more interesting is to see how we get out of that little divergence there. Next one that really caught my eye today, XHB, the home builders ETF. By the way, it was October 18th that was the previous all-time high of this market, with yields dropping and mortgage rates obviously soon to follow. Housing become temporarily, at least, from one day to the next, looking a lot more affordable from terms of, mortgage borrowing costs. Yeah, XHB going up 4.4% today. Big move to the upside. Last chart of the day, I'm still short semiconductors, SMH, with the fund SOXS. We're just kind of floating sideways here a little bit. I'm of the belief that it's likely, with me and my crystal ball, that this head and shoulders top pattern will play out to the downside, and all these large red candles here just pushing lower. So many of them, so many engulfing ones, and this setup. This is a market I can't sit on the sidelines and watch it collapse without making any profits. So we'll see how it plays out. I only bring it up today in case I have watchers that only see the Mondays show or are not aware that I'm short semiconductors right now and would be and would like to know that. So, but yeah, I still have that short position, and that's all from me and my crystal ball. I hope you enjoyed. Thank you for watching, and see you next time. Robschild.